Today, welcome to the Alternative Olympics. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. It's another Friday, and Tarric is back with me for another conversation. Tarric, hello, great to catch up with you. We're in crazy times again.
Yeah, it feels, I think it was Lenin who said that there are some decades where basically nothing happens, and then there are some weeks when decades happen. And I feel like it's been one of those months since we last spoke. You've got Biden, dropping out of the election. You've got the various, issues going on in markets, and vice presidential choices, changing environments, and then you've got everything that's going on in Australia. There's just, a lot to talk about.
Yes. And the reason I thought we might call it the Alternative Olympics is because, everyone's focusing on Paris and all of those athletes who've trained really hard and are hoping to get through their particular events, really fast. But there's another Olympics, which is actually the Olympics of ordinary people. And what I'm seeing in all of my surveys are the number of people who are really struggling and, pushing really hard and trying to keep going under huge financial pressures, but it's like the finishing line just keeps getting moved further and further out. So it's becoming a marathon, not a sprint. No expectation now of rate cuts anytime soon in Australia. The truth is that in real terms, real incomes have gone backwards, and particularly younger people. And it's almost as if the politicians who are on the sidelines cheering, have no idea what it's really like on the front line. So I call this the Alternative Olympics.
I think the thing is that they do know to a degree what's going on, but I think it's one of those questions where you don't ask questions as a politician if you don't already know the answer and know that it's favorable. Because if you were to, there's a famous graph from the RBA from a early 2020 report into household consumption, which it breaks it down by age demographic. And it's, I've been using this graph for years because it's fantastic. And what it basically shows is that for people aged under 35, that they've basically gone nowhere since the global financial crisis or shortly after in terms of their household consumption. So that really blows up the whole idea that they're all out there spending big on, iPhones and trips to Bali and everything else, when in actual fact they're not. But so I got interested in that, and I contacted the RBA and I said, can you please share with me the source of that data and the updated numbers? And to their credit, they said yes, quite promptly, and they provided the data to me, and I was very thankful for that. And I've now done the updated numbers, which cover to the middle of 2022, and they basically show that discretionary spending for people under the age of 45 has gone nowhere for about 20 years. Now, if you add that to the CBA data that I put together, I'll get you to put a link in the description into it in another article, which I put it together about a month ago. That shows that younger demographics have gone backwards even further since the ABS data, leaves off. So really, I think that we have a profoundly sick economy that hasn't worked for a very long time for people, and that now a lot of different people are going backwards. And I think that people have every right to feel like they're just really going nowhere when, basically so much of our economy is just being sucked in by the housing market and is increasingly supported by the government.
Well, it's interesting because I've had a couple of economists on. I had Steve Keen on a few weeks ago and Cameron Murray on last Tuesday. And in each of those cases, we were sort of probing a little bit at why is it that the mainstream economists seem to be seeing the economy rather differently from all the analytics that you see and I see in terms of what it's really doing to households. And even the most recent bulletin from the RBA sort of pokes a little bit at some of these pressures, but really didn't go very far. And of course, they were able to justify their analysis based on the securitization data, which they actually admitted was actually a bit flawed in terms of looking at some of these things. So there's a real gap, in my view, between what the official narrative is, which is, the economy is slowing a bit, but everyone's hanging on. There's nothing to see here. And we're going to pull out of this fairly soon. And the reality is that for the last 10 years plus, in real terms, a lot of households are going backwards. And the pressure on those households with a mortgage or in the rental sector at the moment, and those in the younger groups trying to get into the property market, are more extreme than they've been, well, probably forever. So there's a huge narrative gap, and I'm coming to the conclusion that this is actually a bit deliberate.
I think that the key factor in the difference of analysis it kind of comes down to two words that you and I both use quite often: per capita. I think that's what it really comes down to. And I think that part of the problem as well is that you have two major distortions in Australian society. And we'll get into this a little bit with some of the charts. But one distortion, number one, is population growth, almost overwhelmingly through migration. And obviously that makes the headline GDP number go up. So it's rather difficult to have a recession when you're growing the population by, 1.5%, 2% through migration. And then on the other hand, there's the distributional issue in terms of household consumption and who gets the dividend of economic growth. Because as I mentioned before, it's not people under the age of 45. They haven't grown their consumption. They're not out there spending any more than they were 25 years ago. But for people 55 and older, they are seeing that benefit. They are seeing significantly higher levels of consumption. And as you get older, and as you go into the older and older demographics, the higher and higher the consumption growth gets. And this is on a per capita basis. So I think that that's part of the issue. It's all well and good to say, oh, well, the economy is doing well. It's doing X, Y, and Z. It's producing, 2% growth, 2.5% growth. But when that growth is recurring heavily and primarily as a result of migration, and whatever growth is left is driven by the spending of older demographics who are the beneficiaries of things like inheritances, with the median age of people getting an inheritance around about 50 years of age, or they're beneficiaries of equity mate, or they're just beneficiaries of the fact that, that they are hitting superannuation preservation age of roughly 60, depending on one's individual circumstances, and then having this nice big lump sum of cash to be able to spend. And every generation, every year, generally speaking, the balance of that superannuation lump sum payment gets bigger and bigger.
Yes. And as Cameron Murray said earlier in the week, there's about 30,000 people working in the superannuation sector, right? And there's 35 to 45 billion of fees taken out every year. So it's become a huge industry in itself. And of course, the government is now eyeing that 3.5 plus trillion of money, thinking, oh, we should probably use some of that to help with the housing or whatever. So once again, it's one of those things where it may sound sensible to start with, but when you look at what's actually happening, then you've got to ask some quite serious questions. And I actually think you could take that same argument more broadly. The debt hole, for example, which I think just got over 300 trillion globally for the first time ever, looking at the amount of debt out there. So we're in interesting times, and I guess that's a nice segue into your slides, isn't it, really?
Yes, it is actually, with quite a nice little cartoon on how there is relative indifference, shall we say, from the US political class on their level of debt. And they just go, well, we really ought to do something about that. And that includes the US Federal Reserve as well, with its chair, Jerome Powell. But we'll get right into the slides. As usual, people, they are available at burnouteconomics.com, and they will be right there on the front page, and I hope you enjoy them. So we'll get right into it. Now, this is the analysis I put together based on the data that was provided to me by the RBA. And what we've got here is, in the blue, total real consumption growth between the 2002-2003 financial year and the 2021-2022 financial year. And when you look at it in the blue, it doesn't look too bad for some demographics, particularly the older ones. But once you start stripping out the fact that housing costs more, all of a sudden it starts to look quite a little bit less appealing. And I think this just really speaks to the K-shaped economy of Australia, which I think has existed since long before you and I started talking about this, Martin, even though we've been talking about it for quite a long time, whereby the asset holders who tend to be older do relatively well, when the young people or younger people, even people, 45, 50 in some cases, who work for a living, things are much, much less rosy.
Yeah, and just to underscore two things about this chart, this is real. So this is after the effect of inflation, right? Which is a really
Yep.
important adjustment because a lot of the time people are actually looking at numbers that have been distorted by high inflation, even house prices. If you take a real adjustment to house prices, they're rather different from what the top line number might be. And then the other is these cohorts are very, very important to understand that, there's a huge difference from those in the 25 to 34-year-old than 65 years and over. And whilst people drift over time into those cohorts, my worry is that a lot of these people in those younger groups will not have the same asset base as the cohorts currently do. So it's almost like they've taken the drawbridge up as well. So it's not just a matter of, wait on, in 20 or 30 years, you'll be like those 65 and over ones. Chances are they're never going to be able to reach that level.
No, and I think that is one of the places where this analysis does indeed fall down, because it lacks the distributional nature of the consumption. Because there are people who are 65 who are spending less today than they were 20 years ago. Well, there are groups, I should say, because those people are now well into their 80s, but there are groups in these age demographics who are spending significantly less than their predecessors, but they aren't really being captured all that well. And I think that's part of the problem, because you've got these people who, say for example, a majority of people will end up of recent retirees will end up with some form of age pension once they hit that age. Yet the burden, the hurdle that needs to be cleared for that is a roundabout, I believe, for a part pension as a couple, as a homeowner, is around about $700,000 or $800,000. But then there are people who have a whole lot more than that, who are spending a whole lot more than that, who distort the figure upwards. And I think that that's going to be a real issue going forward, in particular due to, which is something that we'll get into later in the show, the issue of inheritances. Because we have this giant, illiquid, $11 trillion property market, but very little of that wealth is actually injected into the economy itself. It's just sort of there. It's very much a paper construct in that regard. But when you talk about inheritances and you talk about demographics and people passing away and the beneficiaries of their wills potentially selling that property and then using that cash for consumption, then that obviously changes the makeup of things, and that could be something I think that could unfortunately tilt things even more towards older demographics further, even though there's that sort of narrative that it benefits the young, when the data very much shows that those who are receiving these larger inheritances tend to be, significantly older.
Yeah, and I think it's interesting. Over the last week or so, there was one article that came out from one research body suggesting that maybe there should be some adjustments, for example, to start taking into account the family home when doing some of the calculations, which would actually change the game slightly. Or somebody else writing, it's interesting that we are still providing more support through government, support to older people. 20 or 30 years ago, that was appropriate, but now more older people are actually more affluent. So hang on a moment, are we still throwing a lot of money into areas where it's not really needed? And I think there's some really interesting and quite complex discussions to have. And I suppose it then becomes a political bun fight between older voters and younger voters, because, of course, if you're a younger voter, what you'd be looking for is quite aggressive approaches in terms of actually helping with home ownership and those sorts of things, and maybe tailing off some of the support at the top end in terms of those age demographics. If you're an older person who's enjoying some of that support at the moment, a lot of people would say, "You can't take that from me. I'm old. I've worked for it. I've paid my taxes." So you can see a bit the dilemma that politicians have, which is sometimes why they prefer to look the other way and say, "Oh, it's all to do with international price of gas, or it's all to do with oil in the Middle East, or whatever, or China, or whatever." Looking for externalities. The trouble is, a lot of the problems we've got in our economy in Australia are homegrown simply because of bad policy over, well, not just a few years, but it's over a generation or two now.
Yeah, and I think this is something that I've discussed with Cameron Murray, which he makes a really interesting point, and this is something where I've actually been forced to reassess my opinion. He makes a very compelling argument that super is a giant waste of money. That basically it ends up costing the government more in tax concessions than it would if we just gave everyone, and I mean everyone, regardless of their income, a pension. And that's really quite a striking figure. The fact that you've still got all these people on pensions anyway. Even though we've got the super system, because it gets gamed as well. You've got these people who, well, you see them writing into the AFR or the Sydney Morning Herald or the Age asking for advice. I've got $2 million, or I've inherited X, or I've inherited Y, or I've won the lottery. How can I manage to squirrel the cash away so I can keep my pension? And this is something that has been echoed to me by financial advisors, that there are people who will literally piss away $500,000 just to get a pension, even though they would have been better off with the $500,000 just invested. So, I think that that's a discussion that needs to be had, but I also think that realistically, it's not going to happen because there are a lot of people who would kick up an almighty fuss, particularly those people who have, some of those self-managed super funds with over half a billion, and I don't talking about $500,000,000 worth of cash in them.
Yeah. And I guess I should also say from my surveys, even of those in that older cohort, not everybody is sitting on a lot of wealth. And a lot of people in those areas are also struggling, particularly if they never owned the property, particularly if they're in the rental sector, or if they've got health issues. So once again, of course, these broad brush stories about cohorts or about how particular groups are doing misses the point that there's a lot of granularity required to really understand what is going on. But the bottom line for me is that currently we have a lot of people across the generations who, from a financial perspective, really have very few choices and options and really don't have capacity to spend. And that should be, I think, of concern to the Reserve Bank in terms of the momentum in the economy. But we've also got others that are actually very freely spending and have capacity to spend a lot more, which, of course, can continue to then lift the inflationary pressures higher. So in a way, you can see that the Reserve Bank is also caught with this dilemma where you've got, as we've talked about many times, the K-shaped economy where some have and some haven't, some spend, some don't spend. And the net of all this is you've got a lot of people who are really caught. And as I mentioned with the the alternative Olympics, where they're still running really, really hard, but not getting anywhere close to the finishing line.
Yeah, I think that we face a very, very challenging set of circumstances because like with that chart that we had on the screen, I think that it shows that, despite the fact that young people have gone nowhere, that someone who left school, in the early 2000s has moved through life and has basically ended up not really any better off than they were than their predecessors were at that time, even though and not only that, but this is based on the CPI, which obviously people have raised issues about whether to what degree it actually accurately represents the cost of living, and B, the issue of housing. for someone, in the year 2000, a house was affordable. The median household could buy the median house. Whereas now, obviously, they can't. They can't get close. The median household can only afford about 13% of homes, according to PropTrack. So we've got a real mess on our hands. And I think the problem is that between the issues of the super system working as intended, the issue of inheritances, and obviously enormous levels of relative household wealth, you put all this together and you've got a recipe for the older demographics and their spending to continue to streak ahead. Now, it's entirely possible that, through a combination of migration propping up the headline GDP as it has, well, for, the best part of 20 years now, and this spending by the older affluent demographics, that things could look okay-ish in terms of the headline figures. But it could mask an absolute wrecking ball hitting, the younger demographics who actually have to work for a living, who actually have to find a way to somehow afford to buy a house, or even, some of the demographics who are a little bit older, who maybe want to trade up from an apartment or a unit to a house. And removing that level of social and even in some cases, you know, geographical mobility, I think are going to have severe social consequences in time. And I think in a lot of ways, we're just lucky that Australians are as apathetic as we are. Well, I don't think we're lucky in that regard. I think the government is lucky. We're not very lucky, the actual populace, but I think that there's some rather significant consequences down the road for that, and none of them are good.
Well, as I've often said to Tarric, Australians benefit from wonderful beaches and for great weather. So, let's go and sit on the beach and have a great time. And let's not worry about these things too much, except that unfortunately, this she'll be right mentality is really not necessarily appropriate, given the fact that the reason we're in this mess is because of a series of decisions taken over quite a long period of time that actually are not necessarily in the best interests of the country and most of the people who live in the country. And these decisions are not just accidents. They're actually deliberate. They've actually been a series of decisions that have been taken by various governments around superannuation and around releasing lending standards, et cetera, et cetera, et cetera, over many years, using more debt and blowing up the economy with more migration. All of those things are deliberate. And it's all based on this predication of, well, top line GDP is everything, right? But as you said earlier on, and we keep saying, per capita in real terms is only the way to actually look at this. And if we look at it in that terms, then it's nowhere near as good. One last point on this before we move on. The 11 trillion, that's paper wealth. And when you actually stand back and realize that property prices are still inflated by at least 40% over long-term trends, there is still a risk. There's still quite a risk that it could actually begin to ease down. If it does ease down, not only does financial stability become an issue, but of course then the wealth that people have on paper start dissipating, and that could actually have its own risks, which is another reason why I believe the government will do almost anything it possibly can, and a few other things too. A couple of double somersaults with Pike, to go back to the Olympics, to keep the prices going up.
Yeah, well, I mean, I said somewhat tongue-in-cheekly, I think it was I think it might have been towards the end of 2021 that there was more hopes and dreams for the government to throw on the fire before this was over. And that's exactly what they've done. I mean, we had a very nice housing correction going on there. Prices were, undergoing a nice little gradual mean reversion. Nothing was blowing up. I mean, you've seen it in New Zealand where things have occurred to a much, much greater degree than they have here. And nothing's exploded. Nothing, the sun hasn't burnt out. We haven't seen the four horsemen of the apocalypse. Everything's fine. And even though in some places in New Zealand, property prices have crashed by more than they did in the US in aggregate during their housing crash. And we had a nice little opportunity there for things to the froth to be taken off the top of the market and for things to unwind in an orderly fashion. But we couldn't have that. So instead, the government turned, the migration dial up to 11. The rental crisis became entrenched. And as your data shows, Martin, more and more and more people saw having a home as an escape from this and needed to buy, and obviously that puts upward pressure on prices. And then, as what basically nearly always happens if you look at the data, investors jump on the bandwagon once they see that prices are rising, and then you've got the good old Aussie perpetual motion machine. Maybe physicists should look into this, and they can solve cold fusion.
Well, it's a completely different way of thinking about reality, isn't it? As we sometimes say, maybe it's reality that's on the blink here, because the trouble is that the bigger the bubble, the bigger the risk of it ultimately going pop. And there's a problem that you have to keep stoking, not just on a linear fashion, but stoking it more and more and more. So it's a logarithmic problem. So it actually takes more and more effort to keep that bubble in the air. And I think New Zealand is a really interesting example of where things are beginning to ease down a little, but in a relatively ordered state. And, the latest data on New Zealand is suggesting that with a little bit of a reduction in migration and a little bit of focus and a little bit of adjustment to some of the lending criteria, you can begin to morph the trajectory. It's a lesson that we have to learn in Australia, in my view, but it's unlikely in the short term.
Indeed. And we should probably get on to the next slide, because I think we've spent about 20 minutes on this one. Okay, this is Australian quarterly real retail sales per capita. There's that word again, per capita. And well, they've basically gone nowhere since about 2008. There's been some growth, but it hasn't set the world on fire. And I think that that's a real nice sort of illustration of, despite the fact that you have some very affluent households spending a whole lot more, even when you distill that down to an average number, an average per person number, not even that level of increase in the spending of the more affluent demographics is enough to rescue the retail economy from a rather dismal time.
Yeah, and this is really interesting, because what this shows you, it's really from the global financial crisis, 2007, 2008. Before that, things were not too bad. But since then, with everything that's gone on, with interest rates being cut, with the massive amount of debt being created and then spent, it's not actually in real terms had significant impact. And we should just underscore, this is excluding food, groceries. So this is everything else. And that's with the significant discretionary spending from some on things like international travel and holidays and those sorts of things. So there's your problem in terms of actually understanding why the economy is not motoring.
Yeah, exactly. And I think that part of the problem with the perception surrounding the Aussie economy is the first half of this chart, is the fact that the people who make the decisions and a lot of the electorate who obviously vote and make decisions on economic management still have the rose-colored glasses of the mid 90s through to the global financial crisis on. And I think that very much distorts things. People, I think that a lot of people just don't understand how badly things have gone. And there is just the assumption that, well, it was like this when I was your age. Why isn't it like this now? And I think this raises an interesting question. This is something that I've actually been meaning to ask you. Do you think that the growth of the Australian economy between, say, let's call it the mid 1990s and the global financial crisis is actually, for want of a better word, is a majority of it actually real? Or is it just the impact of the rise of China, the mining boom, and basically just enormous household debt expansion?
The answer to that is that it were those three factors together. Of course, the deregulation of the financial system, which started in the 80s and went on through the 90s into 2000, increased the multiples dramatically in terms of what people would borrow for a given level of income. And that was a real big updraft in terms of what happened to property prices. And we also had, of course, the entry of the securitized players into the mortgage market, like Aussie John and a few others as well, which created capacity to lend a lot more. So that was, for me, a very, very significant issue. The mining boom, of course, was dramatic, particularly in the West. And we saw that, we'll probably touch on Perth prices a bit later, but it was very interesting watching what was happening in Perth earlier on when the mining boom then gave an extra updraft to property prices. And so, yeah, absolutely mine. And then there's China and the exports to China. And of course, the stimulus that was actually coming through because we had the Asian crisis in the early, early part of that chart there, and that created even more investment momentum from particularly China, and that came through to Australia too. So I think we had three very significant updrafts all coming at the same time. One reason why Howard was able to give a lot of tax back, because of course the economy grew dramatically and the tax take grew dramatically. But what should have been realized is that these were all blips. This is not somehow a new fangled, different way of thinking about the economy. These were three discrete forces creating a very significant level of momentum, probably too much momentum. And then, of course, when it started to ease back, then you have to try and pull those levers to try and counteract the downdrafts rather than the updrafts. And that's what's been happening since 2007. So we had the debt crisis, particularly from the Northern Hemisphere global financial crisis. We had China stimulating further post 2007, 2008, did a lot of that. And then, of course, we had the continued release of capacity to borrow because interest rates were taken down and down and down and down and down, which gave people the ability to actually leverage up even more. So those forces are actually the major forces that have been in play for the whole of the last generation or two. But the question, Tarric, is it possible to repeat again, or are we going to actually go sideways or down? Because none of those things are necessarily repeatable.
Yeah, that pretty much sums up my concern. All righty, on to the next slide. Now, there was a question from a viewer in the comments of the last video talking about what basically, is there anything that can negatively impact the path of the Perth property market? So I'm going to have a few special slides here on that, and we're just going to sort of get through them relatively swiftly. Basically, Perth is basically the most undersupplied property market in Australia in terms of listings on market. New listings continue to remain weak. Total listings are the weakest in the nation in terms of year-on-year growth. And I think it's just worth noting as well that year-on-year number is coming from the low base seen in 2023, which comes from the low base seen in 2022, and so on and so forth. So Perth listing numbers are very, very much depressed. Whereas you look at Sydney and Melbourne, where total listing numbers are up by significant double-digit percentages, and property prices in Melbourne are falling, and property prices in Sydney are stagnating to the point where they're roughly at that equilibrium point where they could tip over and tip into contraction if the current trends continue, which is a point that's made by Louis Christopher at SQM.
Absolutely. Well, we're really seeing some quite interesting signs, and in fact, Spaces. I don't know whether you've seen the Twitter links to Spaces there, but they actually have quite a lot of data on sales, and they're actually beginning to question whether the indices that are being produced are actually representing truth, simply because if you have a small number of large value properties being sold in a particular period, that could distort the way the index actually works. So I think that watch and wait. Melbourne definitely is going backwards. as you say, Sydney looks to be a little bit shaky. We're seeing prices falling in Hobart and Tasmania, and some of the other areas are easing, but Perth still very strong, and of course a lot of migration into Perth as well.
Yes, very, very high levels of per capita migration, which is something I might get into in our next show. We might actually have a graph on per capita migration into the various states. I think that'd be something interesting for the viewers.
I think we should do that and also look at external migration and also interstate migration, because there's a lot of people down the East Coast heading west as well.
Yeah, that's a good point. We'll definitely look into that. Okay. Now, in terms of vacancy rates, things have improved somewhat in Perth recently, but vacancy rates remain pretty depressed, really. And not in a, unfortunately, depressed in this instance is not, it's not positive. Vacancy rates are still very low. And while there has been some improvement, I think it's going to be a long, long road before things, get back to where they were prior to the pandemic. And I'll just add that I think that there's going to need, for a more substantial turnaround over a shorter amount of time, there is going to need to be some sort of economic shock for that to occur, which in fairness is not unprecedented in WA's history, who has had many shocks, both positive and negative, to its economy and to, the state of affairs there.
Yeah, I can remember going over to Perth. It was after the mining boom, about 5 years afterwards. And I was walking down the main streets in Perth and noticed how many of the high-rise building projects had actually stalled. And I was talking to the locals, and they say, "Oh, this is nothing unusual. We go boom, bust, boom, bust. We've always done it, and we probably always will." And a few people were saying, "Well, just wait 5 or 10 years, and we'll be through another cycle." So Perth is very, very, very exposed, of course, to particularly the mining story, and has been benefited hugely from China. Although, of course, with what's happening on in China at the moment, and after their recent massive conference with very little coming out the back of it, the suggestion is that China is going to go through quite a period of weakness, which will put perhaps some weakness back into the Western Australian market too.
Indeed, and that's something that we're going to get to right now. This is a chart of the amount of iron ore sitting at Chinese ports. And as you can see, it generally follows, at least to some degree, a seasonal trend. It heads up early in the year, generally right up to Chinese New Year. And then once Chinese New Year finishes and everyone goes back to work and all the steel mills, go into overdrive, it will then fall. But this year that hasn't happened. It's just gone up and up and up and up. And it continues to go up despite the fact that seasonality has favored falls in the level of stock for a while now. Now, this has raised questions from everyone from Westpac to The Economist as to why this is happening. Now, there's, some people have raised the possibility, well, they're stockpiling it because of a potential devaluation of their currency, or because of, they're preparing for a much, much more frosty and difficult trade and geopolitical environment. I think both of those theories have merit, but I think it just goes to show that for a while now, the iron ore price, and by extension Australia's fortunes, have been getting supported by these additional purchases of iron ore by the Chinese. And I think that it speaks to our reliance on China, in the sense that if this was to not even to stop, but just to slow to a normal developing nation level of steel consumption, even double, let's call it double the level of normal steel consumption for a developing nation in the latter stages of their development. If that were to happen, it would basically be curtains. It's not, it would just be an absolutely enormous hit in terms of prices. But I think it's also worth noting that for a long, long, long time now, the Simandou mine in Africa has been on the horizon, and people have been saying, well, when Simandou opens, Australia's going to get hit by a truck. It's going to get hit by a truck. And people have been saying that now for the best part of a decade. Well, according to Macquarie, it's finally going to open next year. Now, whether or not that's actually going to happen, considering the fact that this is West Africa that we're talking about, and that there are obviously political issues and stuff that can come up and have come up in the past impacting the mine. If the mine does finally start producing, and we do start to see this West African iron ore flowing into the market to a greater degree, then that's going to change the calculus because no one globally is growing at a fast enough rate to be able to supplant the demand that China has for steel. Now, people say, well, what about India? India is on a mission to be as self-sufficient as humanly possible. And India is a net exporter of iron ore. They don't need ours. It may be nice, but they don't need it. So I think that is a really key point going forward. This isn't like LNG or thermal coal or any number of our other exports. For iron ore, China is the only game in town. And if their demand really tanks badly, they're taking us down with them.
Yeah, and there was an interesting announcement, I think it was this week from Fortescue, saying that they expect the costs of their operations to rise by about 10% ahead, which means that the costs of the producing is also now going in the wrong direction too. So if you've got weaker demand and you've got potentially higher production costs as well, that squeezes things even more. So this is a very significant potential tipping point. And as we've said before, WA is right in the crosshairs, really.
They are, and I think that it's just worth making like just a point here. Australia, generally speaking, has some of the lowest cost price iron ore production on the face of the planet. And even if things were to really hit the fan, our mines would be among the last to be hit in terms of their actual core viability, in terms of their running at a profit.
Mm.
So I think that it needs to be kept in perspective in the sense that will things, if this, sort of downside scenario was realized, things would be much, much more challenging. The federal government would have to deal with, across the Chinese commodity complex, tens of billions of dollars less in terms of, turnover, revenue, you name it. But, in terms of economic multipliers, etc. But there's still a silver lining in the sense that we will still always have a resources sector that produces, quite strongly, that still, makes a major contribution to the federal government and to, the economy more broadly. But eventually it's just not going to be to the same degree that we used to, even with the rise of the green minerals and everything else, because they're just not big enough to be able to replace those things like iron ore and the fossil fuels. Not in the short term, anyway.
And one last quick point on Western Australia. Of course, Western Australia is benefiting from very significant GST-enabled support because of the previous government, right? Let's just think about this. So just the state with the biggest economic dynamo running at the moment, with the biggest growth in house prices and the biggest migration, is also now receiving support from the other states that are actually more heavily in debt and whose growth momentum is slowing. You've got to say that at some point somebody's got to ask a question.
I think that if we continue to see a Labor government in Victoria in particular, they are going to flip, and they are going to flip hard on the federal government, because Victoria is really, really hard up against it. They sold off part of, Vic Roads, which for those who are not from Victoria or perhaps not familiar, is the registration and licensing arm of the government. I think that, and meanwhile, WA gets a sweetheart deal, even though it's raining money. Doesn't really make much sense. And not only that, but even just recently, there's been quite a push from some economists. I believe it might have been, just off the top of my head, I think it was Saul Eslake, basically saying that the sweetheart GST deal for WA doesn't really make sense.
Makes no sense at all. But hey, that's politics, isn't it?
Yeah, especially in Australia.
Exactly.
Okay. Now, this is of job vacancies at a national level, excluding WA, versus WA. And as you can see there, towards the end of 2021 into the start of 2022, they opened up a very, very wide gap between the two. But more recently, they have been converging. Now, I will say that I don't think that this, as a broader indicator, is its, shall we say, strength is an accurate representation of the labor market more broadly. But to be completely honest with you, considering the fact that the economy is apparently making 50,000 jobs a month, maybe it is. I don't know.
Well, of course, it all depends on whether you believe those statistics, right? I just remind everybody that the monthly statistics came in quite a lot stronger than people expected this last time around. But if you look at the sampling changes, then you can explain quite a lot of the move. So, there's something really weird on that in that data set that I'm not sure we can trust.
Well, the thing is, the sampling this time was actually a negative. Sorry, was actually a negative. If not for the sampling being worse, the number would have been even higher. And I mean, just top of my head, you're talking potentially about, say, 55, maybe 60,000 jobs in a month. That's the equivalent of the US economy making over 700,000 jobs. Now, that just outside of the recoveries from deep recessions, and well, that's pretty much it, really. That just doesn't happen. But here we are.
Yep. And that's one of the reasons why some people are suggesting that the Reserve Bank will have little choice but to lift rates when they meet just next week now. Certainly the inflation data isn't necessarily going in the right direction for them, and the jobs market still looks pretty strong. And as you say, if you actually look at some of those sampling issues, it would have actually been an even stronger number. So hardly evidence that the employment story is crashing in Australia.
Well, yeah, I mean, I will say, if that's what they got to do, that's what they got to do. I mean, the problem is that the ABS have, sorry, the RBA have got their hands tied. If the ABS says, that the economy is going great guns and is producing 11 million jobs, and that inflation is still high, that's their mandate right there. So, they're just going to have to. Although by the same token, I'm not sure if you saw the article recently, covering some of Lucy Ellis's comments that she reckons that the RBA is bluffing. And to be completely honest with you, I tend to agree with her.
Well, she was an insider, so she probably knows how they think. And it's not the first time that central banks have bluffed. But if the data keeps coming out supporting, higher rates, and as you say, their mandate is twofold. It's the employment mandate and it's the inflation mandate. Well, if they're both off target, well, they haven't really got much choice, have they?
No, exactly. Now, people will be familiar with this graph as we get into it. Usually every couple of months, and well, Kiwi housing prices, they're falling again. Net migration moderated. Rental growth over the last few months in New Zealand has, I think, rental demand is down 30% since migration peaked, and has inexplicably fallen every single month that migration has fallen. And rental growth in New Zealand over the last 3 or 4 months has dropped to a grand total of 0. And housing prices are doing their thing and falling. Although I will say, I will just make one little addendum to this that is somewhat concerning for anyone wanting more affordable housing in New Zealand, and that is the level of investor activity and this is likely on the back of the fact that the government has reinstated negative gearing. The level of investor activity recently hit its highest level since late 2021. So that's one thing to keep an eye out for, I think.
Yeah, certainly seeing a resurgence of property investors there. And whilst I suppose you could argue that that actually helps the supply of rental properties, a lot of the property that they're buying is precisely the same properties that first-time buyers would aspire to buy, and they now have more capacity for as an investor to buy them previously. So, once again, you can see how I come back to this basic point. The property market is a market that's absolutely messed up with government intervention left, right, and centre. And so, if only they'd let the market be the market, we'd have a much more rational market. But no, politicians can't help themselves. They always feel they've got to go in and pull this lever and adjust that one and do this and do that, and basically try and achieve their ends. And I sometimes think they end up with a messed up market because of it.
Well, sometimes I wish that they could just, you and I talk about announceables, the things that they can announce, but things that they don't actually do. Sometimes I wish that they would just do announceables and just never do anything.
Yes.
We might be better off.
Well, there are a few countries around the place in Europe where they haven't had effective government because, there was an election, no party had power, and then they spent months and months and months and months actually trying to work out what to do about it. Nobody noticed. Interesting observation there. Maybe we could remove the political sphere out of existence, and maybe that would make things a whole lot easier. Cost a lot less money.
Well, I mean, if a deeply hung parliament will work, maybe we'll get to see a bit of a preview of that.
Indeed, could well. Looking at what's happening at the moment, that's certainly possible.
Speaking of property investors, I recently, thanks to a source in academia who I'm thankful to, I recently managed to get a hold of the historic data for investor from the ADS on lending to property investors. And property investors used to make a massive contribution to the welfare of the country. A large majority, at some point, almost 2/3 of lending to property investors went to building new houses, which was great because they actually expanded the dwelling stock. And I think that investors that manage to do that are great. And I think that that's a really positive thing for the investor and for the broader populace, because they're creating from nothing a place for someone to live, not taking a house from the owner occupier column, usually a house that a first home buyer would or property a first home buyer would find appealing, and then putting it in the investor column. Whereas these days, as little as 13% of investor lending actually goes towards building or buying new properties.
Yeah, I'll just make the point, Tarric, that that's an average across the country. If you actually look at specific areas in and around Sydney, for example, or Sydney in and around Melbourne, in fact, the proportion of investors buying new or builds has almost fallen to zero because the supply of new property has fallen away dramatically. So it's actually worse than that average, I think, because of what's happening in some particular areas at the moment.
Yeah, it's a mess. And to be completely honest with you, I understand why investors don't, because in a lot of cases it doesn't make sense. In the late 1980s, or sorry, the mid 1980s, you could easily get a property with a rental yield in double digits, where earnings growth was running in high single digits, and in a couple of years you'd be laughing, well and truly positively geared, and everything would be fantastic. Whereas these days, where wages growth is a lot lower, where the cost of living is biting a lot harder in a lot of different ways, it's just not as viable. And I think that that's a big issue in the sense that the market signals for Australia are broken. You look at somewhere like Austin, Texas, where rents went to the moon. All of a sudden, all these investors went, well, let's build houses. The yields are fantastic. Let's actually, add something to society, and make money while we're doing it. So great. And now rents in Austin have fallen by something like 12%, and they're continuing to fall because markets work and the government isn't screwing with it. Whereas here in Australia, because we've got things like negative gearing, which allow people to, over a long term, run a strategy that loses money, it doesn't work. The market signals just aren't there, at least
No,
not in aggregate.
no. Well, it goes back to what we said about let the market be the market rather than actually what we've got at the moment, which is effectively a series of, well, amazingly bad policies from an overall perspective, although, of course, particular segments have benefited significantly in recent times. But the bottom line is this, that the net impact on the property market is higher prices, less availability of property. And by the way, the average net yield on investment properties continues to fall across Australia. And even with some of the recent rental increases that we saw, because of the higher costs in the system as well, more investors are actually underwater. And that, by the way, is leading to the situation where more investors are now wanting to sell their investment properties, particularly in Melbourne, where we're seeing a lot of that, and now in areas of Sydney in particular. And that's because they cannot make it work from an economic standpoint. So even with all of the supports, even with all the government stimulus and everything else that was through the system, and with all the tax cuts and tax breaks, many investors are still not able to actually make it work. So again, it shows you that the system is a bit bust.
All I can say about Melbourne is, can you imagine what things would look like if they didn't have high migration right now? Within, like if the anecdotes about investors selling are correct, then property prices would be getting smacked.
Yep.
But we have rental crisis and we have high migration. So
Yep.
Unfortunately, we can't let that happen.
Got to keep those prices up. We've got to keep that 11 trillion in the system. Otherwise, financial stability would be at risk, and people wouldn't feel as wealthy.
Well, I mean, I think it's much, much better to risk social stability than financial stability. I mean, I think we both know which one of those is more important.
Well, in financial stability, we trust.
I think as part of the RBA's renovation, I think you should get them to put a big marble arch with that printed on it, right out the front of Martin Place. I think that'd be quite nice.
Well, I think that's right, and I think we should also share the same banner over the APRA guys as well, because that they're there. Although I did note, amusingly, that ANZ is saying that, well, if you actually reduce the lending standards a bit further, we could lend some more. Well, I thought that was quite an interesting observation. Pretty logical, really. But yeah. Would you want to do that in the current environment?
It'll happen. I bet money it's going to happen.
It's one of the most obvious levers they can pull to keep the Ponzi just running a little further.
Yeah, I mean, like if I could get odds on Sportsbet on that, like I'd be getting all my chips and going all in on that one.
Oh yes.
All right. Now, recently, the Commonwealth Bank released a paper on job creation, which breaks things down by market and non-market jobs. Now, non-market jobs are defined by the ABS as jobs in healthcare, social assistance, education and training, public administration, and safety. And market jobs are basically everything else. Now, market-based jobs, according to the ABS labor force account, which the ABS says is the most accurate indicator for broader jobs growth, that shows that market-based jobs are actually falling to a very, very minor degree. But it also shows that non-market-based jobs, so basically government jobs or generally government-funded jobs, we're creating almost 300,000 of them a year. So we've got a rather interesting little situation here whereby the RBA has their foot squarely on the brake, trying to, slow down job creation, trying to slow down wages, trying to slow down spending. And the Albanese government and the states and territories are creating, almost through their policies and by extension, almost 300,000 jobs a year, which is more jobs than we were creating in the whole economy at some points during the prior to the pandemic.
Well, there you have your burnout economics in writ large. And the fact is that a lot of the jobs are important jobs, the healthcare jobs, but from a wealth creating, productivity generating perspective, they won't necessarily have the multiplier effects as some other jobs in particularly the private sector. And that's part of the problem. That's one of the reasons why overall growth and productivity is not where it should be. So we have more people in those sectors being paid by governments, which means that basically the taxpayer, directly or indirectly, is paying for them. And what that means, of course, is that the mix of the taxpayers versus the people being employed is also morphing so effectively. More and more of the whole pool of cash in the economy is going in to support the government sector. So if you look at the public-private splits, they're pretty much more adverse than they've been, well, forever.
Yeah, exactly. And I think the thing is that I'm not ideologically opposed to a larger public sector in principle. Now, if this expansion was driven by additional doctors or nurses or AMBOs or frontline staff, then fine. You know, I mean, there isn't even 300,000 nurses in all of Australia working, in frontline roles. But anyway, but I just think that's the problem, and it's all well and good for a lot of people to jump on their high horse and say, well, this is healthcare and social assistance jobs, ergo it must be good. It's like, well, no, not really. And to be completely honest with you, frontline services are falling to bits. Bulk billing is slowly going the way of the dinosaur for, the working poor Australians who don't qualify for a healthcare card. And on the other hand, across the states, across the board, across the severity of patient condition, outcomes for people in emergency wards are deteriorating. So clearly, this enormous expansion in government-funded jobs isn't working. Yet, and to be honest, I wish it was. I wish that we were actually employing the people that we need, but we're not.
Right. But what it does do is it boosts the employment statistics. Maybe one of the reasons why we've actually got the numbers we've got there. And so people can say that, well, the unemployment rate is lower than it's been for a long, long time. But you've got to come back to the quality of the jobs and the growth momentum that is created or not created as a result of it. And it's interesting, the UK, of course, the Labour government's now been in just for a couple of weeks here, and they already announced some programs to try and lift growth. And they've actually said, well, we're going to create a UK energy entity that's going to actually focus specifically in public-private partnerships to get offshore wind happening and onshore wind happening and things like that. Now, those are things which actually are designed to try and get growth, but also reduce costs. That's may or may not be worthwhile. I'm not sure. We'll see, I guess. They're also saying, oh, we found there's a huge hole in the budget compared with what the last government said. Surprise, surprise. Always happens. So they're talking about, well, we're going to have to put taxes up now. So we'll see where that comes. But my point is this. If you actually invest in the right public sector and ancillary areas, you can create growth momentum. You can create economic activity. But the question is, what is the evidence to suggest that what's happened in Australia in the last 2 or 3 years in particular has led to a right economic outcome? I don't see much evidence of it.
No, unfortunately, it's not there. And I mean, I think the thing is that there is a dividend, an economic dividend. If we purely reduce this to numbers, we, forget about our normal concern about our fellow man and society and stuff that, that define us as individuals, and just think about, just be absolutely, hard-nosed bastards about it for a moment. Even from that perspective, fixing issues in the health system and even issues with mental health, which cause people to be out of the labor force, to cause people to be out of, the normal sort of circles of society. And they don't want to be out there in a lot of cases. And I'm not suggesting for a moment, that we can help everyone, because we can't. Not everyone wants help. Not everyone is is reachable. That's something I've seen, firsthand in my own life plenty of times. But the idea is that there is help there for those who need it when they need it. And there is an economic dividend to that. There is, there's getting people, because at the end of the day, these people, if left to their own devices, these people who are in a really bad way are going to be a burden on society from a monetary perspective. So even looking at it from that very, very narrow perspective, we should want to get them out of that particular hole. But for some reason, the will just isn't there. And I don't, and to be completely honest with you, that's one of the mysteries that I've never really understood since I came to, become educated in, economics and finance and reading all the various literature that there is on this subject.
"'Tis mystery all," as they say. Yeah, I mean, it is pretty amazing. And when you talk to politicians, it's very interesting. I mean, I had a few offline conversations with politicians recently on some of these issues, and they sort of admit that some of the policies that have been played out have not been equitable, have not necessarily hit the mark in terms of results and outcomes. But of course, they're under whips, and they're part of a structure that means that they can't necessarily do what they want. So the political processes and systems that we have don't necessarily support the outcomes that we aspire to, and that, I guess, is part of the problem. The machinery of government is also broken here.
Well, what do they say? The purpose of a system is what it does. I mean, but what we really need is a Cincinnatus to march on Canberra, fix what needs to be fixed, and then bugger off back to his farm.
Yeah, it's been done before, but yeah. Well, my view is that the problem is that the purpose of politicians and the purpose of the political machinery is to make sure that you get re-elected next time. Period.
Yeah, unfortunately so. Now, this is a really nice chart that Antipodean Macro posted on Twitter showing basically how much extra cash since the MyEFO will be injected into the economy by the federal government and the various mainland states. And that's a lot of money. Now, I pulled out the old economic history book and a calculator earlier today, and I came to the conclusion that the level of cash that is being injected over 2023-24 and 2024-25 by just these decisions taken after the MyEFO is roughly in the same ballpark as the stimulus packet, the second larger stimulus package provided by the Rudd government during the global financial crisis when indexed to GDP.
Oh, that sounds inflationary to me, Tarric. That sounds inflationary.
Yeah, so this is the plan. We're going to grow the population by about 2% a year, and then we're going to inject an economy saving, and I quote, economy saving amount of money from the federal government, the states, and the territories. How can anyone possibly claim, what's the word I'm looking for? Competent economic management and saying, oh, we've done such a good job staying out of recession. It's like, do you have any idea how hard it is to have a recession when you're growing the population at 2% and you're throwing a Rudd stimulus size package at the economy, all while just saying, well, it's, just business as usual, folks.
Oh, you got to say that politicians are quite clever, aren't they, in terms of dressing up the story and, look over here, we're doing this sort of stuff, when actually over here, through misdirection, this is what they're actually doing, right? Because, the jobs mix that we've highlighted, the fact that we've got this massive amount of additional flow of liquidity into the system, all of those things. But, I mean, the RBA will be aware of some of this stuff. And going back to my point, looks like inflation here is being home built.
Honestly, if I was the governor of the RBA, and in possession of the requisite bulletproof material, which I would definitely end up needing if I was the RBA governor, um, after the release of the budget, I would have just raised rates by 0.5%.
Yeah.
Just said, bang, stop it. Enough. You know, it's our job to reduce aggregate demand in the economy. And that's what we're going to do. And if you guys keep doing stupid stuff, we're going to keep raising rates. And if you don't like it, too bad. But of course, instead we've got the what did Lucy Ellis call it? The bluff.
Yeah. And of course, the RBA is ultra sensitive to the political environment that they're part of. And, they will always try to, dance a careful tune as to what they say. But when the numbers are so out of kilter, you've got to say at some point, some of these things are going to come home. So, your burnout economics URL and philosophy is so central now to this. If only people understood what the implications were.
It's one of those things. I mean, I got up in front of a conference room full of people almost 2 years ago and outlined this theory. And it's one of those things where I really, really love to be wrong, but instead things have been taken to their not quite to their logical conclusion, but well along the road to it. And it's just ridiculous just watching the RBA just be neutered by, these enormous levels of cash injection and just an aggregate demand injection that really shouldn't be happening. But at the end of the day, it's all politics. And I don't know. I feel like in a lot of ways, politicians have coddled the public, and that the public used to be a lot tougher. Not even tougher. People are tough. They're more than tough enough to deal with whatever crap the economy and bad times and everything else can throw at them, because humans are humans and we adapt and we thrive and we find a way. But for some reason, politicians just think that we can't do it. And instead of just allowing cycles and things to happen and for people to face hardship, overcome hardship, and then get on with things, they're intent on preventing any hardship from ever occurring. And I mean, I don't know about you, but have you ever met someone who's never experienced hardship and then they have to?
Yeah.
It's not a pretty picture.
Absolutely. Yeah. Well, you get it lulled into a false sense of security, if everything always goes right, then until it doesn't. But unfortunately, life sometimes throws negative things at you left, right, and center. And I'm amazed at the resilience of people that I've met through my life who've gone through really, really difficult times and come out the other side quite a lot stronger. And I actually think sometimes if we could only get government out the way, rather than actually trying to sort of put a finger in every dike to stop this one falling over and that one falling over, ultimately we probably would be in a better position. We'd be in a more resilient position, and we'd have a set of politicians perhaps who would be more interested in solving some of the real issues we've got, rather than the ones that have been created because of bad policy. But hey, no. And like I said, remember, they're only out in the market there to get themselves elected next time to keep power. So that's the number one, number two, and number three priority.
It's funny that, you and I at times get labeled like socialists or interventionists, or all these different things. Yet I think, just judging by this conversation we're having right now, that both of us favor a small government that does very specific things. Say for example, like providing a safety net or providing social housing, all these different things, but in a limited government providing what is required by society to a degree that it has historically, and just basically just going back to the settings that worked, and I think is the most crazy thing to me about government, of them just throwing their hands up in the air and going, well, we don't know what works. And it's like, well, yes, you do. Here's a book. Flip through it. Oh, well, if government, crushes costs and does what they need to do and builds a load of houses, it can drive down the cost of housing. Okay, and that got the home ownership rate to a record level. And that was almost 60 years ago when the most sophisticated, tool in most people's truck was a hammer. I mean, seriously, like the answers are there. They just they just don't want to touch them. Now, why they don't want to touch them, that's a whole other debate.
Yes. Yes, bring back free market economics and intelligent government intervention. A central bank that does more than just monetary policy, but actually, like the old Commonwealth Bank used to be, which was effectively a public bank for public investment and for public good. The cornerstones are there to actually take it in a completely different direction. But we seem to have got ourselves caught up in this neoliberal philosophical view. And then we've got this idea that government needs to solve every crisis and get more and more involved. And that means that, of course, with big government, more and more of our taxes get sucked into supporting big government. So they have to tax us even more to be able to actually cover the costs of big government, which goes on in a perpetual motion machine. And then, of course, we actually have the asset inflation that follows because they have to issue a lot of debt because you need big debt to be able to pay for all the government. So, I mean, there's a series of logical conclusions based on how things are currently done. But as you say, there is a recipe book out there for a different way of thinking that would actually lead to a much more just set of outcomes and, maybe a smaller set of government entities, which would probably be a good thing.
So I think to sum up, what we're advocating for is free market capitalism with a safety net.
Yep.
And I think it's kind of crazy that is somehow a controversial viewpoint in 2024, but here we are.
Well, you've heard it here first, folks. There is a route, there is an approach, there is a way of dealing with these things, but it isn't about pumping more government money into more things. It isn't more, increasing the size of government even more. It's a different way of thinking, but one which actually gets down to tackling the real issues that we can see in the real economy. Tarric, I think this has been a very, very enjoyable conversation. Thank you. And thanks for the slides and charts as always. And hopefully we'll do it again when we can. And I'm sure there'll be more to talk about because these topics are very, very important, but they're also highly controversial.
Pretty much, mate. And well, it's an election year in America, and there's all sorts of crazy stuff happening with markets. I'm sure there'll be plenty to talk about.
I'm sure there will. Take care. We'll see you soon. Cheers.
Catch you later, mate. Bye.